Good afternoon, everyone. This is Shauna LaRue-Marai from ICF, and we are here as part of Session 2 of Pennsylvania's Department for Community and Economic Development, or DCED's, Determining Income Training. Hopefully, you joined us last week, and you are familiar with WebEx and the technology. Hopefully, you enjoyed Mentimeter, which is our polling software. I'm going to start today by launching Mentimeter, so have your smart device ready or open up a new browser to menti.com, and I'm going to go ahead and give you the password to log in. So let me just launch my Chrome here and grab the Mentimeter. We will give it a go in just a second. Okay. All right. So be thinking about your favorite Pennsylvania food. So you will see the menti.com is in the upper right-hand corner here, and also the code. Go ahead and put into your phone or your separate browser 249015. This is our icebreaker for today. I think some of you know from last time that I'm a big fan of Pennsylvania food. So I want to see what your favorite foods are as today's icebreaker. So as you put in the code and you put in your favorite food, it's going to get bigger in this particular exercise, the more people put in the same thing. Oh, I'm seeing all sorts of great things here. So, all right, shoofly pie is definitely a Pennsylvania favorite. I see that it's not quite so large. Funnel cake is massive. I'm from Indiana, and we call funnel cake as an elephant ear, although I realize it's not quite the same thing as a funnel cake. Pierogies are here. Oh, wow. Oh, I'm going to have to ask for some translation for some of these. The halushki, I need to know, somebody's going to have to tell me what a halushki is, because I've never heard of that. Definitely cheesesteaks are a favorite. You guys probably have your favorite ones, particularly around like the Philly area. Whoopie pies. Whoopie pies are excellent. Gotta love how cakey and also the icing that's on the inside. I'm going to need to know what a gab is. I don't know what a halushki is or a gab. Oh, soft pretzels. Yeah, one of my favorite memories is going to a pretzel place right outside of Lancaster. Really old town, had wonderful soft pretzels. Maybe you guys can help me with the name. So I see subs. I see. Oh, Harry's hot dogs. Excellent. All right, Thrashers. I don't know where Thrashers is, so somebody's going to have to help me out with that one. Did anyone say Scrapple or anything? Like, I want some old school type food things here. Anybody put Scrapple? Maybe no one likes that. Okay. Amish apple dumplings. Yum. Yum. Okay. All right. Will somebody chat in and tell me where Harry's is? I want to know what a halushki is, and I want to know what a gab is. Gab. G-O-B. I want to know what a gab is. Okay. Thank you, everyone. That was super fun. Going to go back to the presentation. So this week, you might remember in terms of the presentation, we did a lot last time with kind of setting up your processes, and we talked about how important it is to have a good application and to include good questions on your application, as well as being inclusive in case there are additional members that maybe you hadn't anticipated. We also mentioned that there are two definitions of income, but we didn't go into any detail at all. So my goal for today, and I think DCED's goal for today, is to really unpack each of those two definitions and really get into the nitty-gritty. And then if time allows, I'm going to go through some of the case studies on the HUD exchange in the CPD income eligibility calculator But I did notice that that was also on tomorrow's agenda for office hours. So we'll see how much time we have. I could always do additional examples during office hours tomorrow, or we could just simply run through your questions, detailed questions on household information in terms of income and asset sources. Just like last time, I am joined here by DCED staff. I have Kimberly, who's going to help with the Q&A box, and also we have Nicole, who's helping with any type of technical support. So if you need technical support, please use the chat function, which is you just kind of hover over the PowerPoint, you'll see a little speech bubble comes up. Or if you've got a question that you would like to ask me or DCED, use the Q&A box and type in your question, and then periodically we'll stop and answer a question as we walk through the material. So hopefully y'all are ready. Maybe you're thinking about your shoot fly pie, but let's get going. Okay, so this is calculating gross income using the two definitions. And a couple things about the two definitions. So there used to be three long ago. The last one that's not here is census or the American Community Survey. The main definition that the majority of folks out there are using is the Part 5 definition, or Section 8. And that's the one that's HUD's definition. All of the community planning and development programs have always had Section 8 or the Part 5 definition of income as the preferred definition for folks to use. We maintain a list of inclusions and exclusions on the HUD Exchange, and so you'll see there is a link here, and you have that in your PowerPoint, where you can just go directly to that link and pull what's currently included and what's excluded. So that's a really handy document to have on hand. It doesn't have to be used with the income calculator. It can be used in your program, and it is the best resource because we try to keep it up to date. Part 5 also has, besides inclusions of income and inclusions of assets, we also have what's called an imputed asset calculation, and that is something that is specific to the Part 5 definition. I have a couple slides on it, and it's where if you've got more than $5,000 in cash value, you take a certain percentage of that and compare it to income from an asset. So it is one of the more unique pieces of the Part 5 definition. The IRS definition, many of you might be using for some of your programs, and the 1040 definition includes income and asset inclusions. And the key thing here is that it's taxable, and I'm going to talk about that when we cover 1040 at the end of today's presentation. So it has to be taxable income, and not all sources, as you guys know, are actually taxable. So we're going to talk about what that means. And then there are certain deductions on the 1040, deductions for things like student loan interest, for alimony paid. There's a whole list of deductions. And what I try to do whenever I do any of this type of training is to make sure that you guys are going directly to the instructions for 1040. And it's really important that you download the form as well as the instructions. And they do change year to year. There was a significant update in 2018 forward in the tax law, and the form, the 1040 form, looked completely different. They moved a lot of things to Schedule 1 that we were used to seeing in the main form for the 1040 definition. So here's a link to what's included in terms of instructions, and then, you know, there are a couple of tax benefits, or benefits that are not taxable, I should say, when folks receive any type of emergency assistance. So I thought that would be helpful to link to that, depending upon a couple of the storms and other things that we've had. So I recommend strongly that you read the What's New in the Tax booklet. It can be very, very helpful. There is a different version of the 1040 that's actually a little bit larger in terms of like the print, which is amazing. So it's the 1040, but it's the 1040-SR for seniors. So that was 2019 forward, so that's a little bit different. And then virtual currency, Bitcoins, and things like that is considered like other income. This is one of the things that with our gig economy and other things happening, we now have a place to talk about other income and include other income in terms of the 1040. So I'll talk more about the 1040 at the end of today's presentation, but I am going to start with the Part 5 definition because, again, that is the most popular. So following the link that I provided on the prior slide. When we talk about Part 5 and what is included, for the most part, we're talking about gross amount of wages, so what somebody's earnings are from a job, salaries, their overtime. I know that was a question from last week. Overtime, bonuses, somebody might earn a commission or tips. I think I introduced you guys to my sister Michelle last week. She was a waitress for a long time before she became disabled. I'm going to talk about Michelle throughout this course, but the tips, you know, she had to make sure that we you know, quantified her tips, just like anybody else that you might have in your portfolio. You know, sometimes that is through a cash contribution form where you have the applicant tell you what kind of tips they have, or it might be that she's reporting them to her employer. But everyone's different. Everyone makes this decision for themselves. So you want to make sure that you're including all wages, all salaries, overtime, commission, tips, and bonuses. And that would be for everyone that you're serving in terms of Part 5. We also mentioned last time there's a lot of self-employment. So net income from a business is something that you can, in that case, you can use a tax return. Even though you're in the Part 5 definition, we mentioned last time how helpful the tax return form can be. So net income from a business is right there on the front page of the tax return if it's current. There's also, and we put this in the TA manual, which was also sent out with the slides last week. In the TA manual, there's a whole section on net income from a business, and there's a form that you can download from the HUD Exchange that might be really helpful. I'm sure you guys will have some questions about other self-employment, but it could be, you know, what's provided on the 1099 and things like that can be really helpful in terms of business income. Periodic payments, so any type of Social Security assistance, SSA, that's for seniors, Social Security disability, Social Security supplemental insurance, all those things that are coming into the household are all gross amounts, as we mentioned. So you want to include that. You want to make sure that you have the letter. You don't want to include net income from Social Security. Somebody might be receiving annuities or any other regular contributions to their income, and you definitely want to count all of that. Okay, so payment in lieu of earnings. So unemployment, temporary assistance for needy families, which is welfare assistance, all of those are included in the Part 5 definition. And as we mentioned last time, we have a whole slide earlier in the presentation about unemployment. We are not talking about that supplemental $600 of emergency unemployment. We're talking about general unemployment is counted, okay? And will be in the foreseeable future unless we hear about other waivers in terms of unemployment assistance. So if there's any other type of welfare assistance that's provided to the household, here's a reminder, we're not talking about in-kind support, so food stamps or food that might be provided from a food pantry or clothing. That's not what we're talking about. This is, you know, public assistance that's provided for welfare. So any type of, if you can call it an allowance, so it comes in periodically, monthly, weekly, quarterly, alimony and child support are really good examples of that. So that's what the household receives, and you want to count what they actually receive. That's always been a common question. We talked about armed forces last time, or those that are military. That might be a good example of who might be temporarily absent from the household. You want to count all military income, any allowances, housing allowances, anything like that, all regular pay. The one thing that you don't count is hostile fire pay, and that will be included in their earnings statement. And then if we have earnings of temporarily absent household members, we spent time last week talking about who's temporarily absent, who's permanently absent. Those that are temporarily absent are still considered a household member. Their income is still considered. They just happen to be working somewhere else. And the best examples are seasonal workers, and we also talked about those that are active duty military. And so the idea is that even though they're somewhere else, they're still actively contributing to household income, so we want to count them, okay? Different from those that are permanently absent, who might be in a nursing home or elsewhere, the head of household gets to decide if they are counted as a household member. And if they're considered a household member, then their income is also counted. Okay? So that's what you include in terms of Part 5. So that's what you include. And so I'm going to go through a couple of the more common exclusions. So this is income that you would not include. Okay? So you might want to highlight or underline exclusions for yourself that might be helpful. So earned income of minors. So we know minors in Part 5 is considered under the age of 18. So in high school, for example, like I worked at the Gap, I certainly did not contribute anything to the household. I was buying clothes. I was saving for college. I was doing all the things that a normal teenager would be doing. So my income was not counted, okay, because it was my earned income. Now, the funny thing about the Part 5 definition, not funny, but just like different, is that you need to differentiate between earned, which is a job, versus unearned income. So sometimes there are children out there that have unearned income that is paid on their behalf. So child support's the most common, but we also know that some children receive supplemental Social Security, SSI, because they're disabled, or they might be receiving, I've seen, death benefits for a parent. I've seen pension payments from like the railroad that are paid to a child on somebody else's, behalf because one of their parents is deceased. So, so we want to take a look at, and this is why it's important on your application to have ages. You want to know who are the adults in the household and then who are the minors. And then for minor children, we want to know whether or not they have earned income or unearned income, okay? And we should be asking about unearned income. We spent a while last week talking about the income of live-in aides and the fact that live-in aides are typically not family members. They're typically residing in the unit because somebody needs help with their activities of daily living, and they wouldn't be living there otherwise. So since they're not a household member, that means the income from that live-in aide or the children of live-in aides, which I've never seen children of live-in aides, just FYI, in my 20 years. But you want to make sure that you're not counting the income of that live-in aide. And I mentioned before, and I'm happy to send over the definition that HUD is using of live-in aides. I noticed it wasn't in the TA manual, but we're happy to make that change if that's helpful. I know a couple of you had that as an issue that you wanted to solve last week, so we're happy to do that. So we also have those that care for those who are in the foster care system. So the payments that the household receives is not included, okay? I don't know in New Jersey, but I know in Pennsylvania, but in New Jersey, we also had legal kinship. So we had those folks that were guardians for others, and they received payments for their care. Those specific payments are excluded. Lump sum addition to assets. So if somebody inherited a lot of money or there's lottery winnings, all of those things are considered a lump sum. Now, when we get to assets, you will see them. So in case you're worried about, well, people shouldn't have a lot of money in inheritances and still be eligible for my program, I totally understand. You have to have your own policy about assets, which we'll talk about. But just these sort of lump sum additions, like those amounts that come in one large chunk, those are excluded because it's not periodic. It's not the same thing as wages that are earned over time. So reimbursements. So reimbursements of medical expenses. We also have, people ask all the time about reimbursements for mileage. Basically, if it's any type of reimbursement of your income, you're double counting it. So you do not need to exclude or include medical expenses because you've already been paid, somebody's already been paid back for those medical expenses that they've already paid. So, so people that are paying co-pays or paying for medical equipment, things like that, for gross annual income, it's excluded, is another way to say that. And then currently for the home program, this is just for home, we have a situation where we have those who are living in rental or tenant-based rental assistance programs. And this is only at recertification, but there is an earned income disallowance. It's called EID, and we are not including increases in their income for disabled household members. And so that could be over time if a disabled household member like earns a little bit more in terms of their income. So maybe when you qualified them to begin with, they were at 20 hours. Now they're able to ramp up to 40 hours. This says you don't include the difference between the 20 and the 40. And this just gives them sort of a short-term benefit because, and again, my sister Michelle, who's disabled, I mean, as a waitress, her hours went up and down over time. I mean, we never knew, and she has horrible multiple sclerosis. We didn't know when Michelle could work a full week or when she couldn't work a full week, but yet could be eligible for, you know, some type of home assistance. So anyway, so just kind of keep that in mind. That is something that may go away, and I have a slide at the end of the presentation. They did some changes to Part 5 definition through the Housing Opportunity through Modernization Act. So there was a Housing Act that was passed underneath the Obama administration in 2016 that said, hey, let's take a look at these Part 5 inclusions and exclusions. Let's make some changes. And this is one of those that as part of the proposed rule may change in the future. So just kind of stay tuned. Right now, the earned income disregard is included in terms of we exclude that additional income, but it may change in the future. Okay, so last slide on exclusions for Part 5. So if there's any type of financial assistance that's provided, so scholarships, student loans, things like that, and it's paid directly to the student, okay, or to the educational institution, basically helps them go to school, that's excluded because it's not about like paying for housing and things like that. It's to help them afford school, and that's why it's excluded. We mentioned hostile fire pay is excluded. There are a whole slew of training programs offered by HUD and also other federal agencies that are excluded. We just include Section 3 here. There is some Section 3 like training programs that have been made available over time for those that are working in minority or underserved low-income businesses. So those are excluded. Any type of sporadic or temporary income, including gifts. So grandma gives you $50 a year. You do not include grandma's $50 a year in terms of what you include as a household's annual income. So it's temporary, it's short term, or it's sporadic, which means we're not really sure when the funds are coming in. So gifts count in there. This is also the same category, you might remember, that we mentioned the Social Security, the unemployment. The additional unemployment is temporary, that's $600. So that's why it's excluded, because it's sort of a one-time thing, if you want to think about it that way. So the next two categories are something that we should really zero in on, particularly students, because we have a lot of confusion, I find, about students in general. And we mentioned last time that the home program is not about serving entire households of students, okay? We don't do student housing as part of like the home program or for CDBG either. But we may have some full-time students living in our household that we're serving. And if the student is full-time, then you would only count $480 of that student's income toward gross annual income. So if somebody is full-time at IUP and they're in an income-eligible household otherwise, they live with their parents, but they have some type of job that they have on campus or off campus, maybe they earn like $1,000 a month, you would not include that $1,000 a month. The only thing you would include total for the year would be $480. And it needs to be a full-time student that is not the head, spouse, or co-head of household. So it just has to be a member of that household, okay, for that $480 to only be considered. And I'll probably say this later, but if you do use the calculator, you do need to make sure that you are associating the $480 with the student who is the member of the household. And I'll show you what that looks like. All right, adoption assistance. So unlike foster care that's completely excluded, we do include adoption assistance over $480. So you want to include $480 per adoptive child. Okay, so if the household earns $1,000 per month to take care of adopted children, you would only count $480 total for the entire year. Okay, so it's just capped. And before anyone asks, I have no idea why it's $480. It has been like that my entire income eligibility career, which is like now at 23 years. It's always been that way. Somebody thought that was a good idea. Part of that HOTMA rule is to do some increases in some of these like set numbers and look more at like a cost of living adjustment or something like that. So, okay. So in terms of additional exclusions, so any type of deferred payment of Social Security or veterans benefit. So it came to the household as like a lump sum. So my sister Michelle, we spent 4 years. She kept reapplying for Social Security. I know some of you have been in this boat before. You know people in the world. So it took 4 years. She was finally awarded, and we went through legal aid, finally awarded her Social Security. Okay, it came in as a lump sum amount. So we're excluding it for income, but you know, something like that, again, usually shows up in somebody's like savings account or things like that. So we'll deal with it as an asset later, but those deferred payments are not included. And then because, you know, folks, again, because we're in the middle of COVID right now, there could be others who are waiting for their Social Security that you might be serving. So just kind of keep that in mind. If they do get a lump sum, you would not include it as normal income. You would include it as an asset. So any type of refund, rebates, anything like that. So you put solar panels on your home and you get a refund for the state, okay, which we're doing this in Ohio. You might be doing it in Pennsylvania. That's, again, a reimbursement of what you've already spent, a reimbursement of income. So that's why that's not included. Now, this one causes some people some concern. It is specific in Part 5. But if the state pays for the care, like a family member who has developmental disabilities, then the payment that's made to take care of that individual is excluded. And it's just developmentally disabled. It's not any other type of disability that is included in Part 5. This might be one of those that may change over time, but currently that's what it says. And then you may run into this. So there are various federal statutes where there is an income that might be earned by some of your households. We already talked about food stamps, but you could run into AmeriCorps volunteers or VISTA volunteers. Some folks work, on Meals on Wheels, and they're paid out of like the Older Americans Act because they deliver meals. All of those are excluded from gross annual income. And then earned income tax credits is a tax credit on your income. Those are also excluded and wouldn't be counted in terms of the Part 5 definition. Okay, I'm just going to pause there, just take a break here for a second. Kimberly, do we have any questions about income inclusions or exclusions for Part 5 that might have come in the last, 25 minutes?
No, we did not.
I can't imagine. I covered everything so clearly. All right. Well, it's time to challenge you to stump the trainer. Okay. So please let us know what we didn't cover, what you'd like to have covered.
The only thing I will add is that gobs is another name for whoopie pies, and halushki is cooked cabbage and noodles. But I will also add that here in Schuylkill County, it's not just cabbage and noodles, but it's tons and tons of melted butter and some onions thrown in.
Okay, both of those sound amazing. So I'm obviously missing out, particularly on this. Sounds so good.
But no, we do not have any questions yet at this point.
Okay, great. I know somebody mentioned that I was off camera. I'm on camera. I was just giving you a break from my face. But I can leave it on for the asset piece, so we'll go back and forth. Okay, so what's a little bit different about Part 5 is that we have a lot to unpack related to assets. So income is what's earned periodically. Assets, we need to kind of treat differently, okay? So assets, in most of the clients that we work with, we're going to be talking about checking and savings accounts, okay, and any income that's earned on those, types of accounts. But assets in general are cash or non-cash that can be converted to cash, okay? So it might be properties that are owned. It might be, certificates of deposit, retirement accounts that I'm not earning as income because I'm not of age. How do we treat those? So there's a lot of different assets that we can talk about. One thing that I know is specific in one of the DCED manuals is an asset limit. So there is no specific asset limit in either home or CDBG. It's really up to you if you want to have a policy. So I've seen many jurisdictions around the country who have said, I'm going to say that if you have more than $100,000 in assets that you can access, then we're not going to serve you in our program. That's an example of an asset limit, and currently in the regulations for either program, it's not required. But you may decide that you want to have that as a policy, going back to if something bothers you or you feel like in order to lower the playing field or have everyone on the same playing field, you need to make things more equal. An asset limit might be helpful for you to administer. But just like with everything we talked about in the first presentation, if you apply this, it's part of your program design, it's part of your application process, it's revealed to all of your clients so that they know that we're only serving people who don't have a lot of assets, okay? So a couple other things. So in the Part 5 definition, which we know is used not just in home and CDBG and others, we might also be in the rental world, and we might also be working in a project. Some of you might be property owners and managers, where the low-income housing tax credit, which is LIHTC, they don't require verification of assets. So you don't have to document assets below $5,000. There's actually a form that a lot of state housing finance agencies use where the household signs off. I don't have assets greater than $5,000. So it's like a common form. But what's different is that, at least for home, and again, DCED, it's the same that's going to apply for CDBG as well. You want to make sure that you're documenting all assets. And obviously we're talking about, like, in a non-COVID world, we're still doing documentation. We talked about last time that we have this waiver that for right now, for rental and tenant-based rental assistance, you're not collecting documentation for folks who are qualified April 30th through the end of December, okay? So this is in a post-COVID world that you still need to document those assets, okay? So here's a simple example, and it may not be common in your jurisdiction. I find that, so many communities, particularly around Pennsylvania, you've got some really underserved areas where people make, very low income, and you've got other areas that are being served where people have some assets. So just kind of keep this in mind that this is meant to be across your entire state where there's a lot of different needs. So we're looking at in terms of what counts as an asset, so we're looking at the market value. So it is, how do I get to a cash value? So the market value is what is the, home might be worth. So maybe they have a second home. What's the home worth on the open market? You need to make sure that you're reducing it by the cost to sell the property, which might be closing costs, things like that. One thing to note is whenever we're talking about an asset and we are looking at rehabbing the family home, we are not including the value of that home, with the definition. So we're not looking at that asset. So Mr. and Mrs. Jones that you're serving with their 3-bedroom house, 1 bath, okay? You're rehabbing that 3-bedroom, one bath house. Don't include the home's value when you're trying to look at that asset. So we have a market value. What's the dollar value on the open market? What is the cash value? So what does it take to convert it to cash? So I have another example of maybe you have land that the household owns. It's worth $25,000, and the cost to sell it is $2,500. Okay, those are the costs to sell. And then finally that you can arrive at the value of the asset is $22,500. Okay? Again, you may have clients that have value or have land. Some of you don't. Okay? All right. So we had to define what we mean by assets, and then we had to include this imputed asset calculation, which is specific to the Part 5 definition. So the idea is that some assets don't have a lot of interest that's earned. Okay, so for example, no one is making money in their bank accounts right now. And if you are, you need to tell me what you're doing because mine is failing. Okay, I'm getting like $1 a year, maybe 50 cents a year. But like you could have a lot in your savings account, but the income earned on the asset is pretty low. So that's a good example of what we might be seeing in our program. So when an asset yields little or no income, then we should look at, well, what is the cash value? And let's take a certain percentage of that. So this is the imputed asset calculation. So we're going to look at all cash value, and we're going to total all of that out. So we're going to add checking account, savings account, 401k amounts, and we're going to add those up, and then we're going to take a percentage of those. The percentage of those is known as the Passbook Rate. And the Passbook Rate, you have 3 options to use, okay? And this is just specific to home. Just keep in mind that if you're using CDBG and DCED programs, this is completely blacked out in the calculator, which I'll show you. But for home, we have to put in the Passbook Rate. So nationally, it's been 0.06%. That took over from 2%, which 2% was common for a long time. Now it's 0.06%. You could also use the Housing Authority's calculation. Maybe you are the Housing Authority. Or you could also establish your own, where you're going to call around to all the lending institutions, try to figure out your own Passbook Rate. I would not recommend number 3. I would either use the 0.06%, which if you take 0.06% times any amount of asset is really, really small. Or I would check in with my housing authority, okay? And we get to the calculator, you'll kind of see how this works, and we'll be able to take some more questions then. So this is another funny part of the Part 5 definition is that, and this is particularly true with, we've seen this with a lot of elderly households, where they kind of have a spend down requirement, where they have to spend down and kind of liquidate their assets to make them eligible for certain programs. So the Part 5 rule says that if it has been, 2 years or less where the household had an asset that they owned and they disposed of it for less than the fair market value, then you need to include it as part of the calculation. So if they had a home that was worth $50,000 and they gave it to their son for $1, you're counting the $50,000, not the dollar. And you only need to do this for 2 years. We always recommend that you have another question on your application that says, have you disposed of any assets for less than the fair market value during the last 2 years? Yes or no? If yes, please explain why. That would be really helpful. Okay? So we'll talk about that a little bit more. Okay, I thought I had one more slide on the fair market value. So and it's over the value itself. I gave the example of $50,000. The asset has to be valued at least $1,000. So we're not talking about like small assets. We're talking about like bigger assets. So there is a threshold, and that's 1,000. Okay. All right. I thought I had a slide that explains that, but I don't. So we have 2 case studies, but I want to make sure that we don't have any questions in the queue before I go over to the calculator and talk through our case studies.
We actually do. One is, please highlight that insurance premiums are not excluded, but the payment received for the medical premiums is excluded.
Insurance premiums. This may not quite answer, but we talked before about the gross amount of Social Security. And in Social Security, you would always include the amount that is deducted for Medicare. So that gross Social Security. Same thing if you're looking at employment income, your gross income includes any type of medical, insurance, things like that. That's on the income side. Those are my two examples there. On the asset side, we are talking if it's life insurance, you do not count term life insurance, which means that you don't get the benefit until the person has died, but you would count whole life insurance policy as an asset. Those are the three examples that come to mind. I mean, without more information from the person writing in, do you think that satisfies that, Kimberly, or?
I believe so, but I can certainly follow up with them.
Absolutely. Okay. What else do you got?
With CDBG programs, do we have to document assets such as savings accounts? And what does that documentation look like?
So, yes, you have to document it with CDBG. It's always been true for CDBG, the same, documentation. And I can go there in the calculator first for that household, or sorry, for that person on the line. What's different about CDBG is that you don't have that imputed asset calculate, so you don't look at the cash value. So just because you don't look at the cash value for a savings account doesn't mean that you're not looking into the income earned, even though I know it is really small. Add in the income earned on that savings account. So again, it might be like cents, it might be $1, and don't forget you're projecting forward for a year as well. And then so you're including it in the calculation, and yes, you'd have to document it in terms of the client has to provide post-COVID documentation of that savings account, just like they do anything else.
Okay. A grantee has a sidewalk program coded, so this would be CDBG, coded under housing rehab. Does this mean that I do not include the home value in the asset disclosure, slide 53?
So when you have a sidewalk program, you're not looking at household income. You are qualifying that sidewalk program typically under other national objectives like area benefit, or you might be doing a survey. So
actually, I will say that under CDBG 14A matrix code, DCED does allow their subrecipients, their subgrantees, to fund a sidewalk program where it is just the sidewalk under the housing rehab.
Oh, so it's like I'm thinking of home matrix code 14H. But okay, I see what you're saying. So then I would, well, actually it's DCED's choice because it's the rule that you exclude the value of the home. But I guess if CDBG doesn't look at cash value, then it would still be excluded because you wouldn't look at the cash value of that home. Do you know what I mean? There's no imputed asset, so why bother? So exclude the home. Thank you. I had to talk that through together.
Do we have to include automobiles, utility vehicles, ATVs, other little riding type devices like that as assets?
Okay, thank you for that. And I actually had wondered if we had included that on our slide. So personal property of that sort, and that seems like personal property, is not included. So the household car is not included. one might argue that ATV is personal property. The only time you include personal property as an asset is if it's held as an investment. And the list that's included in Part 5 is gems, jewelry, coin collections, antique cars. And what I find is like a good rule of thumb is it insured? Because if something is insured, then I feel like if it's insured, then it has a value to it, and I would include that insured value. But if it's not insured, which some things are not insured, then I probably wouldn't count it. And again, different vehicles are different. Personal car, ATV, different. But other things that they just happen to have as a household, unless they're insured, I wouldn't count them. Like a lot of people, like one reason why I love Pennsylvania is you all love antiques as much as I do. Like a lot of people are like, do I include all my antiques? Are they insured? If they're not insured, I wouldn't count them. Does that help?
I believe so, yes.
You always get more than what you wanted from me, but that's, yeah, hopefully that helps. Again, that doesn't mean you can't have your own asset limit. So if you're like, okay, I don't want a family of 4 with 4 ATVs, like that cash value is pretty high. I don't want to serve. You know, it's up to you what this means to you in terms of your program design, and if you do want that asset limit. Other questions in the queue?
No, we are all caught up. Thank you.
Okay, great. All right, sure, no problem. So I'm a little hesitant to cut to the calculator. Would folks mind if we do our 10-minute break now and come back right at 3 o'clock? Would that be acceptable, Kimberly? What do you think?
I have to unmute myself. Yes, that's perfectly acceptable. And then we can kick right back into the income calculators.
Okay, great.
Okay, thank you.
We'll be back here at 3 o'clock. Okay, well, welcome back, everyone. Hopefully you are refreshed. Quick break. I am going to go ahead and share my screen because I realized that we needed to go back to Menti before I skip to the calculator. So let me know which definition of income you're using now that you've heard at least the Part 5 definition. Let me know which one you're using. So sign back into menti.com. The number is in the upper right-hand corner, which is 249015.
Shauna?
Yes.
We had one question come in while we were on break.
Oh, sure. Let's do that while people vote. That's a great.
Okay, that's what I was wondering.
Yeah.
Is there any income exception for a household with a terminally ill member?
You know, I saw that too, Kimberly, so I was trying to decide. So there is not an exception for anything like that. One thing that I could see is if they happen to be in a nursing home, and remember those folks are permanently absent, potentially, and so you could count them as permanently absent, so then the household would decide if they include them as a member and also their income that they've earned. But I understand that not everyone who's terminally ill is in a nursing home. That's the only thing I can think of that could be helpful.
Okay. And then I saw that you responded to the other person who had issue getting connected, so thank you. So I believe we're all caught up.
Okay, great.
Oh, wait, one more. Please confirm home calculates gross income to income qualify individuals. I believe that you've mentioned that several times.
Yeah, but I kind of want to know what they're thinking. So for both CDBG and for home, regardless of the income source, you're looking at gross annual income for that household. So gross amount of wages, gross amount of Social Security, That's all part of the Part 5 definition. The only exception to that is there is net income from a farm business, net income from a business in general, where you would look at net, but that's the one exception I can think of that's not technically gross.
Okay. Thank you.
Absolutely. Okay, so I know some of you are still joining, so but in lieu of the time here, let's going to go ahead and show the winner, just like we did on choosing Hershey Part versus Kennywood. Okay, I figured that we were still in the Part 5 definition, but I just wanted to make absolutely sure. Okay. All right, so we are going to go ahead and go into the calculator, and I feel like I should show CDBG just for folks that need to see CDBG. So I am going to use this one for Massachusetts, and I'm just going to show housing. And this is just to illustrate the imputed asset calculation is going to look different for you all, particularly because some of you wrote in and said that you work in CDBG, and I want to make sure that you see that imputed asset excluded. So I already had a household ID in there. I already had beneficiary member IDs. This is what I showed you guys last week, so I didn't want to spend a lot of time on those questions. We can go ahead and change this to something in Pennsylvania, though, so that we can, make you feel like we're all at home here. So let's go ahead and use, let's use Chambersburg, Waynesboro here. And this is where you can choose your income limit. So we'll choose 80%. And I'm just going to skip through a couple of these questions about tax credits. I'm going to do Part 5 right now. And I'm going to do the short form, again, just to illustrate. And I believe I already have some income sources in for these household members. Let me just triple check. I might have, okay, no. So I'm going to add an income source for household member B. And I'm going to put in that they are okay. And then I'm also going to add an asset source. And so on this particular screen let's just do savings. On this particular screen, what's going to look different for CDBG is that there is an entire field here that's for cash value that you won't see when I do the home demo. All you're going to see is an asset description. You are not going to see a cash value here. So I just want to say that maybe that savings account is going gangbusters, and it's going to have that. So I'm just going to hit calculate just so you can see. And I'm showing you this. And some of you are like, this is crazy, Shauna, but I am going to show you this because this is absolutely the #1 question that we receive. Like, I get this question every single week. Why does CDBG exclude the cash value? So you're going to see NA for all of the asset sources, and that's because CDBG, the folks in block grant, explicitly exclude cash value. And so there was supposed to be a reg. The reg hasn't been written, but they wanted to exclude it. So in the calculator, we just put NA. If this were home, and I'm going to show you that next, we would have a cash value in here, and then it would total more than $5,000, and then we would take a percentage of that, and then we'd look at the cash value amount, and we'd look at the actual income from the asset, and the greater of the two goes below in terms of the household income and assets. Okay, but CDBG is just fundamentally different. Okay, so hopefully that's helpful there. I'm going to do an a home calculation from scratch. That's what I meant. A home calculation from scratch. I'm going to start that. I did include as part of the scenarios, and I can show that for a second. So in here, I created a couple of case studies, and we're probably only going to get to a couple of these. But I wanted you to see that we have the first family, of course, is the Hershey family. Couldn't forget that. They live in Carbon County, Pennsylvania, town of Goldsburg. And this is a little bit about their homeowner rehabilitation assistance. So this is the family we're going to follow and do income eligibility. So it tells about basically their needs on their older home, and then it gives information about Greg, Mary, and then they've got triplets, Tim, Tommy, and Tony. Greg works at the Amazon warehouse, has a joint checking account, also has a term life insurance policy. Mary works at the elementary center, and then we have some information about her as well as a savings account. So I am going to take this information and put it into the calculator. So just wanted to make sure that you knew that that's what I was going to do next. So, so we know that the activity is owner-occupied rehabilitation. So that is the first screen that you see in home. A little bit different than what I showed you in CDBG. And then this whole section is on that earned income disregard. So in case you ever forget what I said, it's right here, and you're going to see that on the home screen until that goes away, okay? And that was just for rental and tenant-based rental assistance household. So I'm going to call this DCED 1, and then we have 5 people in this household, right? Living in Hershey, living in their 1918 circa home, needs a lot of rehab. And obviously that's pre-78, so we need to keep in mind like lead-based paint and all sorts of things because we don't want Timmy, Tommy, and Teddy to get poisoned, right? So we'll say that A, and we don't use names in the calculator, so we'll say that A is really, what's his name? Mike? What's his name? Greg and Mary. So Greg and Mary, so this is maybe Greg, maybe Mary is B, and then let's assume all the other kids, those 3 triplets, are under the age of 18, okay? So I'm just going to hit continue. And we are in which county again? You guys probably remember. We are in Carbon County. So, so we're going to say we're in Pennsylvania, we're in Carbon County. In Goldsboro, that actually does have a it's the same Waynesboro, isn't it? Has the same
what, Shauna?
Allentown. Sorry, Allentown.
Yes, that would be Allentown.
Thank you.
You're welcome.
And then, one thing to keep in mind, I meant to say this earlier, is the FY 2020 income limits are not in effect until July 1st. So the calculator still has 2019, which is why my case study has 2019. But I just wanted to make sure that you folks were aware. I mentioned it last week, and I just want to make sure that we have the same audience. They might not have heard, is that you do want to make sure that you're paying attention because it is going to change on July 1st. So if you do work in the calculator, couple days before that, save your calculations because anybody you're in the middle of is going to flip over to 2020. There's no such thing as like saving for an old income limit in the calculator, okay? So we've not determined income previously for this household, and I'm just going to go ahead and do the Part 5 definition for DCED. So, so in terms of the passbook rate, this is what we need for imputed assets, right? So I frequently just tell people to use the 0.06%. That is also what the majority of housing authorities use. And then we have the choice, which we kind of talked about last time, whether or not to use the short form or the guided. I'm just going to do the guided because it does have the most information. So I'm going to choose guided. And we also have 2 members that we're going to include the income and assets for. So for Greg, he is number A. Oh, and if we forgot the inclusions and exclusions, don't forget, you can download this here. It opens up in a new screen. So for assets, Greg has, just get to his, he has a joint checking account, no interest. So the joint checking account, and this is cash, and this is, actually, sorry, checking. And then this is checking, joint checking, it's $1,000, okay? And then there's no income earned on the asset, so I just put in 0 in terms of actual income on the asset. And again, home has this current cash value section that we did not see in CDBG, okay? I did not include, and I'm not going to include that term life insurance because only whole life insurance policies are included. So I'm not going to add another. Okay, so I'm done with Greg's assets. And then we're going to put in Greg's job. So Greg works at Amazon. So he's an Amazon employee. He had an hourly wage rate, I believe, of $15. Do folks remember? I know that was fast. $15, yeah. And so let's assume that he works 40 hours a week times 52. We don't have any information about any bonuses, overtime, raises, anything like that in my very short write-up. But as we know, like right now, everyone's ordering things from Amazon. There may be an overtime pay. So I probably would ask and really examine that pay stub to make sure that I understand. Or, as we talked about last time, you could do a third party and see if the employer would provide you with information. So I'm just going to hit continue. And I don't have any other member for, or any other income for member A. And they don't receive any benefits or pensions or anything like that, no public assistance, and no other income. But if Greg was like an Uber driver, as we talked about, or he's got Bitcoins, we would include that as other income, okay? All right, because that's another income source. So that's Greg. Greg is A. So then for Mary, Mary has, okay, nothing is included. So, yes, sorry, B. That's what I didn't do. Sorry. We need to add Mary's income. So Mary is an elementary school teacher, and she has a savings account that earns 10 cents. So we're going to add the savings account. And are things kind of popping up pretty quickly over there, Kimberly? Is there any lag in terms of what folks are seeing? I want to make sure I'm going to the right clip.
No, you're fine.
Okay, great. All right, so that was her only income source, or sorry, asset source. I apologize. So yes, we're going to add a job for her. So she works at the elementary center there in Goldsburg, and then I think we have her hourly rate, and her hourly rate is $7.25. Hopefully, I hope that I caught the Pennsylvania minimum wage, and if I didn't, I am sorry. I always try to check that. 39 weeks out of the year, 30 hours a week. So she works 30 hours a week, and then 39 weeks is what she works, okay? All right, and we have no other information in terms of raises, overtime, tips, because she works at the elementary center, might be doing some administration for the school district. That should suffice. If we did know when she was receiving additional benefits, such as a pay raise or something like that, that we would include that, okay? My goal is simply to show you, if you haven't used the calculator, what you should do in terms of what's here. So, so if you wanted just kind of as an accordion, you could look at each individual household member, and you could just triple check your math here, and then you can hit continue. And then if we're not going to have any other income sources for any other beneficiary member, then we're going to get to the same calculation worksheet that I showed you for CDBG. Same as what I talked about last week. You can export this to PDF. You should triple check, unlike what I did, which MSA that you're working in. In this case, it's Allentown, Bethlehem, Easton. And then it gives you the income limit, number of members, and then you just want to kind of triple check the math, okay? So in terms of this current cash value, we had 1,000 plus 5, which equals 6,000, and then only that savings account earned any income, so that's 10 cents. So if this were CDBG, we'd only look at the 10 cents, but because home wants to look at cash value and take a percentage of it, we actually are going to include the greater of those two numbers and include $3.60, okay? So that's what's brought down to asset income, and then they've added up wages for both Greg and Mary, and then lo and behold, they are below the income limit. okay? So you can, like I said, print this off as a PDF and save it. I'll just show you what that looks like. For home, what's nice is that you could actually type in their last name, okay? So I'm just going to pretend their last name is Amazonia, and then if I wanted to, I could put Greg in here. I could put Mary. You can't do this for every program in the calculator, but you can for home because they really wanted you to have something, because on the second page is where, and I'm just going to go down here, actually it's the third page, is where they're going to sign off. They're going to sign off every single person. We're going to print their name, but they're going to sign off. Again, whenever you implement your homeowner rehabilitation program, they're going to sign off on any adult should sign off on this income calculation worksheet. So they sign their name, and you can print their name, and you can add the date. So if they sign it the same day, so Greg, Amazonia, or certainly that could be Mary. And that opens up like in a new screen, which is kind of nice, so we can go back to the calculator. So that was the first scenario. Let me just pause and see if there's any questions about that. And I'm just going to stop sharing that and go back to.
The only question that came in was asking whether or not Mary would be receiving unemployment during the rest of the remaining weeks. And I would say in Pennsylvania, no, because it was a part-time job.
Okay, thanks for that. I would agree, Kimberly. I would agree. And it's really important, and we kind of talked about this last time, for you to get to know the types of jobs that your clients and be familiar with, you know, the benefits that they might receive. Now, if it makes you feel better that you ask more questions on your application process or something like that, that's fine. I would just make sure that you're asking the same questions for every single applicant so that you're not, you know, potentially put at risk, okay, of somebody making a complaint that you know, did you ask everyone, you know, if they receive other benefits? Okay, so then let's do a second example, just so those that are doing Part 5, and then we'll move over to IRS. This is a one-person household, at least so far. So Katie Brenneman, she lives in Easton. She has a Great Dane named Steve, and she's part of their homebuyer program in Northampton County. And then she has decided to purchase a cute little World War II bungalow. And currently she's living with her boyfriend, but the boyfriend's not on the application. So let's take a look at Katie. So I'm going to go ahead and share on Chrome, and let's include, so she works for the bank. So I'm going to start I'm going to go back to my dashboard, and then I'm going to start a new calculation. And we will start, I'm going to move my head. Okay, so in this case, it's home buyer. The questions are largely the same. I just let you know, but that may change in the future. We're always looking at updates to the calculator, and again, we're kind of poised for this new upcoming change through that HOTMA Act that I mentioned. So we have one household member for Katie, okay, at least so far. So let's call her A, and then she's the head of household, okay. And we are going to choose the same Pennsylvania and then Allentown. I was trying to make this all the same, just to give a little love to that part of your state, not meant to make anyone else feel like it wasn't important. 80% AMI. Okay. All right, so that income limit is $49,000, by the way. Oh, sorry, not income eligible. And then we're going to choose Part 5, and we're going to look at $17 an hour. I got to put the Passbook Rate in. This time I'm going to just include the short form just to remind you of what that looks like. I do find that some people prefer the short form because instead of answering a bunch of questions, they can just simply add assets, add income, all on the same tab, which can be really, really helpful. So, so Katie has a checking and a savings account. So we'll do the checking account, and in her checking account, she has $3,000 in cash value. Oops. And does she earn any income on that asset? Let's look. Oh, it doesn't really tell us. You know, I have to say, like, not too many checking accounts these days have been earning a lot of interest anyway, even if they're called interest-bearing. She also has a savings account, and I'm sure you folks know this, but those of you that are more, like, newer to the program, you know, there are a lot of folks out there who, if they're doing home buyer, they're going to have multiple checking, savings. They're going to have, you know, some additional assets that maybe we wouldn't see like in an owner-occupied rehabilitation program. So she has $10,000 in that savings account, and she earns $10 on that asset. So go ahead and see that. And then we know she works for this bank. Hopefully I chose a good bank there. So I'm just going to put banker. We don't know exactly what she does. So this is what's different. So, you know, on the guided, you'd put in their hourly rate, their hourly rate plus the number of, or times the number of hours they work per week times the number of weeks worked per year. So what's different about the short form, and I would say one of the drawbacks, in my opinion, is that, well, you can do it this way, but then you're going to have to do your own math, which is what I'm carefully doing over here on my phone. So if she works full-time, and if we go back to the slides that I covered, 40 hours a week times 52 weeks is 2,080 hours. So I'm multiplying 17 times 2080, and I get 35,360. And you can go ahead and check my math here just to make sure that that's correct, okay? But I believe that that's correct. Okay? So I am going to hit calculate here. And let's take a look at what we're seeing. So if this were me, okay, and I'm working in this office, I'm going to look at, she has a lot of assets here, okay, and the 0.06% isn't that much in terms of the income earned on the asset, but that's going to be compared to the $10 earned on that one asset, right, which was, I think, the savings account was $10. So we would include the greater of $780 in the $10, so that's why the $10 came down, okay? Okay, so for Katie, though, I mean, she's below the low-income limit, but, I mean, don't you want to know about this boyfriend? I mean, I know I do. I would like to find out, like, he's not listed on the application, so we would need to make sure that as part of our relationship with Katie, whether or not she's said anything, or maybe it's a requirement of your program to ask for the bank application to see is the boyfriend also going to be a household member, okay? So we may see that, we may not, and it may be that we need to document that he is going to live somewhere differently, or maybe there's a self-certification. Katie says that I'm purchasing this on my own. Here's my self-certification of my income. I'm just a household of one. We talked about you could include anything like that if that is helpful. I would just want to make sure that if I'm going with them to like their inspections and we're meeting up, or maybe you're also doing housing counseling and her boyfriend is right there. I mean, seems like he's going to be living there. I would include him in terms of the calculation, which may change. This is only a difference of $8,000, maybe a little bit more than that. But, he probably makes more than $8,000. So I'm not sure Katie's going to be eligible, I'm sorry to say, for her cute little bungalow in Northampton, okay? So any questions about those scenarios, Kimberly, before I move on to the Part 5, the 1040 definition?
The first question, I think, is more of an opinion from you. Do you think it would benefit grantees if DCED provided sample forms that meet income requirements, such as the zero income form? We talked about that last week. The student status form, that was also last week. Various different forms, a VAWA form, release of information, and affidavit of child/alimony support. So,
Kimberly, you probably know, in the TA manual, we provided a zero entry form, so that's there.
right.
The student form is there. The release of information, we provide a link to that form. And then, sorry, the questions all jumped around on me. There was one, okay, now I lost the rest of that. But a couple of those, oh, sorry, the child support, alimony support, okay. So there could be a couple more of those that we could link to, but we don't have the VAWA form there. We don't have the assets disposed of less than the fair market value, but I feel like that's a question. Probably missing is the VAWA form and then affidavit of child and alimony support, Kimberly. Those two things we do not link to in your current TA guide.
Okay. When requesting bank statements, is the requirement for 3 months or 6 months? And is there no third party being requested?
So this is a common question, and it's a good one. So the old technical guide, which I think I showed you, is in the slide deck that we linked to for home. It says an average 6-month balance, like over the course of 6 months for checking. So I would use average 6-month balance for checking. And then, yes, you need documentation unless we are in that period during COVID and it's rental and tenant-based rental assistance where you're not collecting documentation.
And then the last question remaining is, I have an applicant who mentioned they have a friend staying with them for a little while. At what point does that person become someone we should be including? In other words, how many weeks?
You know, that's a great question as well. And this is really, really hard. So I'm going to say a couple things, and I know we cover some of that in the TA manual. So the one thing you can do today is you're going to take a snapshot of that family. And you are required to look at everyone who's there, including the person who's there only temporarily, okay? And if circumstances change, if they're not eligible, including that person, then maybe they can come back and make application in the future. I would ask, as part of your program, do you have a policy of when they can reapply? And sometimes folks say you can reapply in 6 months, sometimes you can reapply in a year, but you do need to include that person. I don't think I would make a policy about what constitutes somebody who's, you know, there for a short period of time. I don't know if I would make a policy about that. And everyone knows there's a lot of people that are hurting these days, and a lot of people are also doubling up. So I understand that maybe some relatives or friends or others are probably living with folks temporarily, but unless you can prove they live somewhere else, I would include them.
Okay. And then we have one request for any suggestions. A few grantees report difficulty in obtaining Social Security source documents. Any suggestions? I don't know if this is, again, like during COVID, but what I usually tell folks, and also to the person who wrote in about the child and alimony support, I would impress upon you guys to ask the client to do one of two things. So I think the easiest thing to do is to make sure that they print out their Social Security benefits, and they can do that with the Social Security office. Same with child and well, not alimony support. I can't speak to that. Sorry. You guys have alimony a little bit different in Pennsylvania. But for child support, you should also be able to print out a statement if it is child support that's covered as part of your enforcement office. So, you know, a statement is good. If it is traditional Social Security, Kimberly, that folks receive that letter every November, that's usually the documentation we're looking for. And you can also get a copy of that letter from your Social Security office. And I usually tell my clients, the client they need to go get that letter because that's the easiest. Doing third party, to unemployment or doing third party to Social Security, I mean, I just simply don't recommend it because it takes too long to get that information. Usually the client can get it quicker than we can as administrators. Okay, thank you.
Yeah, sure. No problem. No problem. Okay, so I'm going to go to the PowerPoint deck, and I would like to, as kind of our final half hour here, is I would like to talk about the 1040 definition, and if we have time, I'll go ahead and do a sample calculation. The majority of you do Part 5, so I'm going to go ahead and say that if you do not do IRS, I do not want you to feel like you have to stay on the phone and our participants are dropping off as I'm speaking. But we will talk to you tomorrow during office hours. But if it helps not to confuse you by listening to 1040, I totally get it. And we would love to see you back tomorrow, and then also the final session next week after adjusted income and tenant-based rental assistance. But we found that a lot of people, do like the 1040 definition. It can be really helpful, particularly if you're doing a lot of income qualification at the beginning of the year, because it's fresher information, it's more current. And some people just find it cleaner and easier. I do find that in my 20-plus years of doing income eligibility training, that we have a lot of folks, and probably many of you on the line, that you might be a CPA, you might do your own household tax returns. Like, this is what you live and breathe. So, and again, it can be really easy to document, particularly if you've got a form that has all the household members. A lot of people like 1040 for owner-occupied rehabilitation, and they also like it for home buyer. So what I wanted to just focus on, and I mentioned this before, is that we had fundamental changes in the 1040 definition that came as a part of the Tax Act that happened in 2017 that was for federal fiscal year, well, actually calendar year, 2019 or 2018 forward. So 2018 forward, we then had a shorter 1040 form that only included income sources that were that were the main part of the IRS definition, and then it moved the deductions to Schedule 1. Okay, and I also have a view of Schedule 1. And so it wasn't as massive a change as I think folks really thought the definition would be. It just looks a little different. So as I train this, I think it's important for you to keep in mind that you could still have some older tax returns in the file if you happen to collect a couple of years of tax returns. Maybe it's net income from a business or some other source. So this is the front of the 2019 tax return that's here. And so you will see that it includes information about, whether or not somebody is filing singly, married, jointly, head of household, et cetera. So for our purposes, IRS does not define our household. That's why I did that on the first training program or training session that we did. You're going to need to probably collect either several tax returns, or you're going to have to outfit your own program to have your own 1040 form that you use. Some people have this in Excel. Sometimes people have a Word document. Other people use the calculator. So just want to make sure that you saw that this is what the front of the tax return looks like. And when we talk about the IRS definition, we're really talking about specific kinds of income that are taxable, that when added together, we're going to get gross income. And we look at this as taxable income, and then we might have deductions that are taken off. Okay, and that's what I mentioned. The Schedule 1 has those deductions. So such as student loan interest might be one that might be common, alimony paid, other types of deductions. So you're going to use the 1040 just like Part 5, and you're going to use the 1040, and again, it might be for specific programs. Home buyer, it might be popular, owner-occupied rehabilitation, okay? And as I mentioned at the beginning of this section, you must use the most recent IRS 1040 instructions. You must. And so that is key. Some of you may have the old technical guide for determining income and allowances for home, you really want to make sure that you have the instructions for the most recent tax year, and that's what you're using. And again, you're looking at the what's new, you're really, including all that. So what is included? So there's a lot of inclusions for gross income, and some of the more popular ones, obviously, are those related to various income sources that they might receive. So this might be gross wages that are included there, and even though it is taxable, it's still wages that we're looking at. We're looking at interest income, so it might be interest earned on some type of savings account or something like that. I mean, all those are fairly popular. Okay. You might earn dividends, so it might be dividends that's earned on a particular benefit that somebody might be receiving. So it might be dividend earned on like some type of stocks, bonds, things like that. So it's just any number of different like dividends. Okay. So other things that we also see is I mentioned net income for a business, and then we also might see things like taxable amount of Social Security, okay, and I'm going to talk about Social Security in a second. We might have IRAs, like basically like there's any number of sources in which we would make sure that we are including, okay. We might look at W-2s in order to reveal this information. We might be looking at a 1099. 1099s are received by those that earn Social Security, and also 1099s we mentioned might be those for whom have small businesses, or might be earnings sort of as part of Uber, Lyft, like all of those different jobs also include, 1099s are received for them, okay? So we're going to look at everything that's included, and then we're going to look at Schedule 1, which includes additional income sources and also deductions. So this is what the Schedule 1 looks like today. And you'll see additional income, and it really kind of, breaks it out even further than what it did on the old form. What's nice about having the Schedule 1 as separate is that you're able to kind of drill down and have more sources of additional income and then more on adjustments without junking up the first page of the old tax form. So if you look at your procedures, you might have somebody you might have as part of your policy to collect the tax return. I would impress upon you, I would also collect the Schedule 1, because that is going to give you information about other sources of income that you can ask about, as well as these adjustments to income, okay? But you're going to have on the front page of the IRS form itself, you're going to have adjusted income number there, but at least you have the background for this. And so you're asking me, like, why? Well, we still have to document. So sometimes the tax return itself is fine because it's within kind of that 6-month window that we talked about in terms of documents being 6 months, current. This is one of those that you would want to make sure that if it's beyond 6 months, like we're in June, I might be able to use last year's tax return, but I also may need to look at if it's July or August, that's really old for 2019 information. I'm probably going to have to collect all the background documentation for income and asset sources, okay? So a couple things that are different that we didn't cover in Part 5 that are different from IRS is life insurance proceeds is excluded. So it doesn't matter the type of life insurance. The proceeds are excluded. Anything that's inherited money or property, there's a couple of rules around that. And then the most common one is child support. This is probably the main reason why I see 1040 used for some homebuyer programs, is because child support is excluded. So that was income. Assets, a little bit different. We do not do the asset calculation, and we don't, we only count the income from the asset. So taxable interest, dividends, things like that, those are all counted, okay? So I know we have a Mentimeter, but I want to go ahead and get over to the application and and show you what it looks like in the calculator. Let me just pause here for a second and make sure that folks did not have any questions so far about IRS definition.
I don't think the questions are relative to what you're covering right now in this IRS definition. It goes back to asking, statement was made that they have an applicant for CDBG who is legally blind, as is his partner, and he says he can legally sign his name. Is it okay for the grant administrator to dictate to him what he is signing, what that person is writing rather, in his application, and then have him sign this? Is it compliant with Americans with Disabilities Act?
I don't think I can say if it's compliant through,
yeah,
but it does sound like you're doing the right thing in terms of a reasonable accommodation, but I would probably ask in your jurisdiction, or if your jurisdiction is too small, about if you've got somebody in your office that could be resource to you for that type of compliance, and or look to DCED for some guidance. But I can't speak to that. But it sounds helpful, but I don't know if that is completely everything you have to do. Like, I don't know if you have to provide things in Braille. Like, I really don't know. I'm sorry, I don't know the answer to that.
The other question, can we get a client to print off the Social Security website? This was going back to, you know, the letter that they would receive. Absolutely.
That's totally fine. And it's better for them to do it because they get a login and everything for their own stuff. And everything's really, you know, high security, not that it wasn't before, but they're the ones who can do it, which is better.
Mm-hmm. Okay.
Okay, great.
I think that's it for the questions. The only thing is, one somebody suggested, is what if they had power of authority to sign for the blind person? But again, I think that goes back to that's a legal, you know, matter. So.
Oh, I think that's right. All right, thank you for that. So, so we do have a third case study here. How do I get to page? Oh, here we go. Sorry. So Nicole probably wants to remind you that you may have to scroll down as well. Like, I can only scroll so far, but hopefully you see this. So I picked this example to try to explain to you how Social Security impacts IRS, okay? So a couple things here. I have the Miller family, and this is also owner-occupied rehabilitation, knowing that many of you, just like in my state of Ohio, there's a lot of rehab going on, right? Lots of needs. So, so there's this common misconception that I will just share, that people think, well, because somebody is making Social Security, that they don't need to file their taxes, which means that their income is not, like, counted at all, okay? So I just wanted to make sure that we touch on this family. So Bennett and Melissa are the two elderly parents, and they have an adult son. And so Bennett and Melissa both earn Social Security. Melissa has a job, and then John also works for a cement company. I hope somebody is from this particular jurisdiction that can know that we looked into this to make sure it was relevant. So, but I'm happy to take any feedback on the next time. Bennett and Melissa have Social Security. So I put this in the TA manual, but I just want to make sure we cover this. So for Social Security, if somebody, and it's going to be rare, if you have people that only earn Social Security only as a benefit, then you're going to need to, and I have a link in the TA manual to the 915 form, you could have them fill out to see if their benefits are eligible. But that's just about their benefits. And there is a threshold for their benefits, whether or not they're filing singly or filing jointly, okay? Filing singly, the threshold is $25,000. Filing jointly is $32,000. And so you put that in for their benefits, but also if somebody has a job. And so there's a calculation in there that you would include both Social Security benefits and the job, and then you see if it rises to the threshold. Okay, So in this particular scenario, and we'll go ahead and include this, their Social Security is not counted because it's below the threshold of $32,000, but Melissa's job is included, okay? And this is a way, in the IRS definition, you actually serve more people if you have a lot of seniors that need their homes rehabilitated, but you've got to make sure that you follow, again, the most recent instructions and also the 915 form. So I just want to make sure that I mention that to hopefully explain that do not think that just because somebody earns Social Security that you do not need to look at any of those benefits. Only a certain amount may be taxable, or maybe none of it is taxable, but until you do the form, then you're not going to be able to see. And I'll just go ahead and I think we have a couple minutes here, Kimberly. This is the IRS form, and I'm sorry if that makes anybody dizzy, and I'm sorry, that you would use. It's 915. And then it explains sort of like, you know, why you're doing this, you know, how do I make sure my benefits are taxable, what's the purpose of this form, and then the thresholds that I mentioned, and then here's a worksheet. And this worksheet, let me just scroll up a little bit. This worksheet then, you look at Social Security amounts, you take 50% of that, you add any other income that they're earning here, and then you figure out whether or not they're, again, Social Security plus job here, if it rises to the base amount, which is over here, the 25 for single, 32 joint. And then if it's below that, then that Social Security is not taxable. Okay, so for this family, and I have already done the math because I knew that we were not going to have a lot of time for this, but the total that they have is half of their income. So their Social Security income is a total of $25,200. You take half of that, which ends up being $12,600, plus her job, which is about $7,000. That's like $19,000. So basically, there's no way that that their benefits are taxed. But in the calculator, we will put in Melissa's income so that we so that we see kind of how this is counted, because if we included all their income, there would be no way they would be income eligible, given their needs. Okay, but their son lives there. He's working as in a cement business. Okay, so I'm not going to put in Social Security, and I'm also not going to put in I'm not going to put in like the calculator does not do the calculation that I mentioned 915 does. And the reason for that is because in the income calculator, you guys, they only want you to total for each household member. They only want you to kind of total all wages here, okay? All benefits on here. So it's just a little bit different than for the Part 5 definition. We actually had a lot of people who hey, sorry about that. So the calculator doesn't do what it does in Part 5, where it unpacks every single thing. You have to be smarter than the calculator, as I like to say. So you're going to need to have the 915 form and your tax booklet. But we would just populate, and we only have a couple minutes here, so I'm not going to go through all the math. We just populate all the wages for the household. We would include the taxable amount of interest for the savings account for Melissa, and we would include John's job. And so we would just include that. So the first member has no income. Melissa has a little bit of income, which is that $75.40. And then she has interest. But then the son is $20 an hour, and we can assume the 2080. We'd have to multiply the 20 times the 2080. And then we would get like $41,600. Okay. So we would include that. And we would do the same kind of calculation that you see before. and then we would do the same kind of printout, export to PDF, okay? Now, the way this form looks is going to change on July 1st because we're going to make the change for the Schedule 1. So it's going to be a little shorter than what you see here, but it looks largely the same as the form. Today, it just will look even better in the future. So that household will be income eligible, you guys, but this is why it's important to know about the taxable amount of Social Security benefits, because it can really throw your household off and they could potentially become not eligible. So I have a couple slides about, and we can do this in office hours too. I mean, there are some fundamental differences between Part 5 and 1040. So Part 5, there are no deductions. 1040, there's a list of deductions. Part 5 includes welfare. 1040 excludes any type of welfare. Part 5 includes gross amount of Social Security. 1040 is only the taxable amount, which again, that 915 form is important. Part 5 includes child support received. 1040 excludes child support received. Part 5 includes alimony. 1040 counts alimony as income. Okay, if they receive it, if they pay for it, then it becomes a deduction. And then, as you know, assets are treated differently. Part 5 has an imputed asset calculation. If there's a cash value of over $5,000, 1040, they include assets, unless they are taxable, and then they would include that. So a couple of rules of thumb. I mentioned before, if you're doing rental, you might have the low-income housing tax credit. They use the Part 5 definition. So I don't know why you'd use 1040 for any type of rental program. Housing authorities, wonderful agencies that operate tenant-based rental assistance programs across Pennsylvania and other states, they're using Part 5, use Part 5. Some people think that Part 5 is really complex. I find it easier because I know that the inclusions and exclusions don't change that often, but some people find that it's a little bit harder to document. But 1040, you have to stay on top of the 1040 definition. You have to look at your tax booklet every year. But I know some of you, that's like your favorite thing, so you're okay. Okay, so a couple things that are specific here that I didn't mention is that besides the most current form is your documentation. That's really important. I think this sort of covers what we've already talked about in terms of income sources. In terms of 1040, so I don't want to belabor that point. But CDBG, you can get away with the 1040 definition and the 1040 form for a lot longer than you can for home. It used to be a common source of documentation that can be used and can be really helpful if you're doing CDBG, like that sidewalk program, for example. I mean, you might as well use 1040. That would be easier than Part 5. So I think that's the end, and I'm just going to switch it over to Chrome for that last question about did today's presentation meet your expectations. If we could go ahead and we can take that last question, any last questions while we look to that.
We have a grant administrator asking if you would suggest putting an application time frame in their program guidelines, for example, April through July of a current year, to stay within the 6-month income verification time frame.
I have never heard that question, but I like where that administrator is going, Kimberly. I could see that could be really helpful if you're using the 1040 definition. And you want to do income eligibility, at one time during the year, but you can still get people served through a homeowner rehabilitation program or home buyer program. I think that sounds like a good solution for a small program.
That was the last remaining question.
Okay, great. Well, we'll just leave this kind of open here. I'll save some of those other Mentimeter questions that I have about changing your definition. We'll do that during the office hour. That might be kind of fun. We'll just leave it open here for a couple minutes and let's see if anyone else had any questions that they want to ask. And if you don't, and if you log off, that's totally fine. We will see you tomorrow for the office hour. So bring your scenarios, bring all your questions. Again, we want to hear what's on your mind.
Thank you. Thank you, everybody, for attending.
Yes, thanks, everyone. 2 down, 1 to go for some of you.